All right, good morning or afternoon, depending upon where you're at. We're going to go ahead and get started now. We've got a presentation here. It's going to take about 20 minutes or so. Definitely feel free to ask questions along the way. The title of our presentation is Defined Contribution Plans and Private Exchanges and How They Can Be Our Future. There's been a lot of new ideas and potential options that are starting to come around now that the exchanges, at least the public exchanges, are a big-time reality in a number of states, and people are still trying to find different competitive advantages. And so what we wanted to do here is just discuss what one of those options might be. We're starting to see those as a defined contribution method. There's definitely been some updates and guidance provided by HHS, Department of Labor, and also the IRS about how these can be used. And how it relates to private exchanges, which actually do exist today. And we'll discuss a little bit about that as well and what those look like and potentially how they're going to look in the very near future. Ultimately, what we're trying to achieve is to create a marketplace that has a competitive advantage. And so can the private exchanges really provide that in the new markets that we're going to have, or this exchange era in 2014 and beyond? So first of all, we really just have to define, sorry about that little climber there, we have to define what defined contribution is. And really it's been around for a very long time, since the 50s and longer, as far as in the IRS code of the United States. But as far as it being, around from what employers have done, it's been around for, for centuries. But generally what a defined contribution is, it's really just a funding method. And it's a way for employers to fund a plan for its employees and its members. Those members almost always are employees, or it's the dependents, the spouses and kids that might have an account that the employer is funding. And these are really guaranteed contributions. They happen on a monthly basis, they happen on a quarterly basis, they happen on an annual basis. But that's generally what they're doing, is that it's a guaranteed funding that comes from the employer, and then that gets put into an account. If there's investments that are involved or expenses that are being pulled in and out of that account, then that balance is going to go up or down, depending upon that interval. Ultimately, what they're able to do and why these have been around is that it creates a tax preference for the employee. Generally speaking, it's something that the contribution that's received from the employer is not considered gross income. There's definitely benefits tests and those types of things that are involved. But from the employer side of things, it's also a tax benefit, meaning a pre-tax benefit. And one of the estimates that came out recently showed that if you look at all of the pre-tax benefits that are contributed by the employers, you're talking about almost $1 trillion per year that are saved for employees and employers. So a lot of money that is put into these types of plans, and a lot of different ways that it's achieved. Traditionally, what we found with a defined contribution plan is that they mainly have been used in 401ks or investments type arrangements, where same thing again, the employers agreeing or guaranteeing that they're going to contribute to a member's or employee's account on a monthly basis, quarterly basis, annual basis, and even have some matching in there. The employees are also able to use their own monies and invest those into that same account, and then they make their decisions from there. The investment decisions, though, are what the employees are putting their money into, or redirecting the money, the funds that were contributed, aren't the responsibility of the employer in this case, or generally in any case. But the contribution is something that's required by the employer. And as I already mentioned, there's a lot of things around discrimination, testing, and those types of things that have to be passed because the IRS has become stricter and stricter on allowing people that are highly compensated or considered highly compensated being able to take too much of the advantage of the benefit just because they can afford to do so. Now, what we've definitely been seeing as an emergency item with these defined contribution plans is in the healthcare industry. Generally around medical plans, but the way that it's being done is really just the same from the employer perspective, is that they're guaranteeing some type of contribution, again, monthly, could even be daily, I suppose, or even every payroll, quarterly or annually, that's contributed to an employee account. And then that employee is using those funds, and sometimes even their own funds in different cases, to make what we can call an investment. And that investment is really to buy some type of health care plan. And then from what they're buying with that health plan, that thing's going to cover medical, dental, or vision expenses. Okay. And then it's able to be reimbursed up to the balance that's been put into the account. Or maybe promised to be put into the account in the case of an annualized contribution. Okay, so that's really what we're starting to see, and the reason why is because of the growing cost of healthcare. There's probably a couple, 2 or 3 options that you generally see these predominantly in. The first one might be a flexible spending account. Hopefully you're familiar with an FSA, but it's an employer-sponsored plan that really just lets employees to set money aside on a pre-tax basis. With that pre-tax savings, the employees are saving about 30 cents on the dollar, depending upon their tax bracket, and the employer is saving almost 8% on every dollar that's put in. So there's a significant savings there, and that's accounted towards that $1 trillion estimate that I mentioned a little bit earlier. But the funds that are being set aside are to be used towards medical, dental, and vision expenses. Those expenses that are eligible are highlighted in Publication 502 or 213D. These are IRS code items and something that is based on a federal level. But obviously you can't double dip. If the insurance plan's already covered and it's not an eligible item. In addition to the employer monies or to the employee monies, the plans that have been really being used for years is these defined contributions for employers starting to add their money into the FSA. Okay. They might be dropping plans, they might be adjusting different options, but the employer is contributing to the employee's FSA account so that there's going to be more monies available for that employee to use again toward those medical, dental, and vision expenses. Something to be aware of, though, is that the employer contributions, because now we have a maximum on what the employee can elect, the $2,500 per calendar year for the employee, or at least what they contribute to their FSA. Employer contributions that they might be contributing do not reduce the maximum an employee that can contribute. Okay, so the employer could put in $5,000 and then the employee can still put in $2,500, but the employee has to use it in that plan year's time. All right, otherwise it just goes away. But in the case of the employer contributing, you have to be aware that there's at least a $500 limit, or if they go above that limit, then they need to produce, the employer does, a summary of benefits and coverage, or what's called an SBC. You're probably pretty familiar with what these are, but the SBC is definitely important because of the auditing that might start coming down the line with these premium subsidies that are going to be handed out. Okay, so that's one basic form of a defined contribution plan, because I just wanted to highlight how these things are being used and really, I guess, broaden the definition so that we all are on the same page about what we're seeing in the marketplace, so that maybe it can be related to an employer of, hey, here's maybe how you've been doing it before, and here's maybe how we're going to do it in the future. Health savings accounts, or HSAs, that's definitely another one that we see defined contribution around. Okay, and in those cases, you're talking about an individual, an employee setting up their own bank account. That contributions are made by the employer and the employee, but they can only be done if there's a high deductible health plan, or an HDHP, that the employee is actively enrolled in. Same expenses that are eligible under an FSA, so you've got IRS Section 213D that can be used. Now, because the high deductible health plans are required by law to be not to provide first dollar coverage, except for in the case of in-network preventive, then employers are trying to offset some of those costs, for the office visits, for the prescription drugs, those types of things. So you commonly find defined contribution from the employer, and again in different intervals, to be able to fund that HSA plan up. Normally the idea is that there's some savings going on with the high deductible health plan from switching from a traditional style plan, so the employer might use some of that savings to fund that HSA account for the employee. Now, the thing to know, though, is that the amount that the employer contributes to the HSA does reduce the amount that the employee can contribute per year. So every single year there's a limit that's set by the IRS that says here's how much folks can contribute. Okay, just like in the FSA, though, anything that if the employer contributes $500 or more to the employee's HSA bank account, then there must again be a summary of benefits and coverage or an SBC provided. Okay. Next one, healthcare premiums. This is probably the first thing you might have thought of when you heard of defined contributions, because it certainly has been around, and it's an option that a lot of people are using in many different ways. But again, as I already mentioned, because of the rising cost of healthcare, employers have been trying to reconsider ways to be able to afford long-term how they're going to be able to pay for benefits. And so instead of paying a percentage of the employee independent premiums, and that might be zero sometimes, they're basically just offering a bucket of money, which is really what this defined contribution plan is. And then the employee uses that to be able to buy their group coverage or their individual premiums. Okay, I see there's a couple questions coming up. I'm going to try to hold off and get through this, and then we'll answer those as we go along here. Sorry, go ahead. So you know, it's one way to do it because the employer is just trying to be able to budget money every single year. But you know, the group premiums continue to grow and grow and grow. So that may not be the best route. So where we have found this defined contribution method used more is in the case of a individual plan, okay? Because then the employee is going to be able to shop for, based on price really more than benefits, what is affordable to them. Okay, so they're taking that bucket of money, that defined contribution plan, normally contributed on a monthly basis by the employer, and then they're using that to go buy the individual coverage that they can purchase. In states that there's no risk pools or there's guaranteed issue or pre-existing condition challenges, this hasn't been very common. But in states like on the West Coast, where most of them have risk pools, this has been a pretty large trend. Normally you find defined contributions in this case with the premiums centered around HRAs or Section 105 plans. Again, all around the idea of creating pre-tax benefits and not creating a gross income to the employee. Okay, those do require summary of benefits and coverage, or the SBC. Now, the biggest challenge, and this was kind of a big hit, is that there was new regulations that came out just about a week or so ago on January 24th that clarified from the HHS, Department of Labor, and IRS's perspective that group plans and HRAs can be integrated and combined, and that's really what these items are clarifying here. But an individual plan cannot be combined with an HRA, okay, and purchasing individual insurance premiums. If you're interested, the link is here from the Department of Labor's website, and they made it super clear on that question there on the bottom that this is how it's going to go forward. So if you have employers that are doing the individual premiums funded with an HRA, it's something that needs to be addressed rather quickly. Otherwise, there could be penalties and fines that are having to be paid. Okay. So if you want the full guidance, just go ahead and jot this down. I'll provide the slides at the end so that you can at least come back to this if you'd like, which also has our contact information. So if you have other questions, you can ask those then as well. So defined contribution of private exchanges. I think before we get into that, one of the things that's probably important to do is to talk a little bit about statistically what employers are trying to say. So why are we even going down the road of a private exchange versus just a public exchange, and why wouldn't they just keep doing what they're doing? One of the main reasons is that about a quarter of the employers that exist today believe that in a couple years that they're going to be able to offer benefits to their employees. Okay, so you're talking about 3/4 of employers that exist are having challenges believing that in about 5 years or longer that they're going to be able to offer benefits. So what that means is that something's going to have to change, something's going to have to break. Now, about a half of those employers, though, between 33 to 40% of those are actually still trying to help their employees figure out how to become better consumers. You've definitely seen that in the high deductible health plan market. But the challenges really are is to be able to adjust a small group premium based off of claims is very difficult because of the community rating aspect. Okay, but where you find most of these employers, and I think this is true across the board as far as the type of buyers or purchasers that are out there for healthcare, is you find people saying, "Hey, listen, I found some information, but I'm not quite sure what to do." So generally, what that means is that they went on the internet, and these are usually your smaller of the employers, and even the employees. went on the internet, got a bunch of information, good, bad, or indifferent, but then they're still looking for someone to help them make their final decision. So if we consider the idea that employers are concerned and believe that they won't be able to offer benefits, but they still want to help their workforce, and they still need an individual to help them make their final buying decisions, I think that might shape the part of the solution of what we're trying to talk about here. And conversely, when you're talking about employees and the statistics you find there, is that employees, as you probably are well aware, have no idea what they're paying. In fact, 80% of them on a national poll don't know what their employers are paying, and almost half of those same employees have no idea what the employer coverage that they're paying already out of their paycheck accounts for. Okay, that to me is pretty scary. You've got people that are buying coverage, but they don't know what the costs are on the premium side of things. Okay, and then most interesting piece is that the folks that don't necessarily know how much it costs believe that they can buy it better. Okay, so it sounds like, you know, there's a lot of education or communication that can be effective. Ultimately, though, employees are really looking for their employers to help them out and make it easy to enroll. They want to make sure that whatever the decisions that are made, that someone's there to help them. Again, an individual at some point is there to really support and help them drive towards their healthier goals. Okay, because the employers are out there, you know, educating their employees, so the employees definitely seeing value in being healthier. They just need more help. Okay, and they get back to the same point where they're going to be able to resource or reference things online, but still need individuals to help them make those decisions. And one of the decisions is going to be buying the coverage, which is definitely going to be a lot of sticker shock coming down the line. Okay, so looking at all of that again, how is a private exchange going to help out with that? Private exchanges are new. They have been around for a while. There's a lot of different ways that they've been formed. But what they really ultimately are is they're a group plan. Okay, gets back to changing the competition from looking at, you know, adjusting claims and those types of things and just shifting it to be based off of price. You have sponsors, and sponsors are the folks that put together your menu of health plan choices. This is a lot of different things. Okay, it's all the way from just the medical plan itself to how you're going to enroll, how you're going to provide the information, how you're going to support the information that's there, and a lot of different ancillary lines that are added. What you're finding with the public exchanges is that they're generally just focused, right now at least, on the medical only. Some of them are starting to offer the dental, or thinking that they're going to offer more than just the pediatric dental, which is the federal law, but they're going to offer the full suite. You probably would guess that in a short period of time, when the exchanges are going to need to become sustainable or get more premium on the books, they're going to extend out to multiple ancillary lines. But at least in the short term here, private exchanges have the ability to offer more than what the public exchanges do from one source. Okay. Once the plan choices are put together from the sponsor, and maybe it's good to mention here, the sponsors are a number of different people. They could be carriers, they could be associations, they could be agencies. We found Aon and Mercer, they already have private exchanges that they have up and going. From the Aon private exchange, they have about 90,000 people enrolled just from one employer. And then you've got about 20 or 30,000 people enrolled just from multiple carriers, or from multiple employers. Okay, associations are definitely starting to look at this and wanting to become a plan sponsor because they may not be a bona fide association today, and they may not be able to become and sustain their association plan because of having to reduce the amount of people eligible to buy from their association plan to become bona fide. So they're looking to become sponsors. So there's a lot of different ways that you'll see that. But once all those plan choices are put together, and competitive advantage is obviously the key, right? Because if you're selling the exact same thing that the public exchange is offering, then why even do it? Because you're not going to really win there. But then you're able to offer the employer something new to do, something new to offer their employees. And really what they're looking at is cost versus benefits. Okay, so the private exchange must be able to provide some type of competitive advantage that helps solve that problem. How can we be more competitive than the public exchange? Okay. Once the employer buys off on that, then you have the members or the employees actually buying from that menu that's been provided by the sponsor that the employer decided that's how they're going to offer it. And then based off of price and different options, the employee actually enrolls. Okay. We're seeing almost every single one of the private exchanges that are developed through the sponsors' options. It's all an online experience, okay, that's supported by paper-type documentation. So getting back to how employees want to buy or how individuals really buy, they resource information online, and then they go ahead and help with an individual in some format to show them how to enroll, because that's really ultimately what they need to get. Okay. Now, as far as the employer, how they fund the plan, because again, these are group plans, they can still stay with the traditional model, meaning that they pay a percentage of the employee and or the dependent premium. And there's reasons why they would want to do that, but depending upon the choices that they have available, this might be the most viable to them. But then you still have the defined contribution model, which is really kind of a mishmash of the individual version of what we were talking about before that's not allowed any further, where basically the employer funds a certain amount of money that's used by the employee to buy whatever coverage they want, and they'd have multiple plan choices inside that private exchange. And then the employer is able to budget based off of that. So it's kind of a nice mixture of both, where the employee now gets to do what they want to do, and meaning that they think that they can buy it better. So now they've got all these menus of choices that they can buy it better than their employer can. And then but then they're supported by the employer and by the sponsors of the exchange on the actual things that they're buying. Okay? So short term, this could be a nice adjustment for the employer, and potentially then long term, depending upon how the private exchange functions and is able to manage their claim expenses. Okay? And then again, we still normally see these types of plans, these defined contribution plans done through an HRA. Because again, because it's a group plan, the private exchange, you're integrating the HRA with the group plan, which is allowable. Okay? So members already mentioned this, but they're able to gain control over their benefit dollars, doing what they think that they can do best. And then it's up to the exchange to make sure it's easy, and the employer to help support, and also the exchange to help support them moving forward, which I think is another area where you create a competitive advantage and are able to highlight what the private exchange is able to do better. You find wellness programs in this. You find a lot of different options that can be creative, which is where I think that the plan sponsors that are doing the best job are going to be able to create the best options that obviously will gain the most membership. Being a group plan, large group employers have some considerations. One thing is that, and this is on a positive side, because it is a group plan that's offering qualified benefits, assuming that you're allowing the correct number of people that are eligible to buy into the private exchange option, the employer is going to be able to avoid a $2,000 pay-or-play tax penalty. Also remember, these are if they did a different way, there would be a non-tax deductible penalty for not offering coverage. So this might be one option that they can look at, okay? Because the restriction in the product portfolios that we're going to be seeing might make it unaffordable otherwise, okay? However, those large group employers still need to consider the affordability test. And what that means is that they need to make sure that they're offering a qualified plan, which you would inside the private exchange, but what they're funding of the plan, if they're using a defined contribution model, is enough so that it's less than, so that the employee is paying less than 9.5% of the employee-only rate. Okay? Otherwise, if that individual employee goes to the public exchange and receives a tax credit, there's a $3,000 tax penalty to the employee or to the employer per person. Okay? So you definitely wouldn't see within, or wouldn't expect to see within a private exchange, non-qualified plans, or at least actuarial value or bronze metallic type plans. But you'd have to consult, meaning the people that are selling this would want to consult with that employer to make sure they understand how they're funding it properly. Okay? Next one. Some additional ones just in general for everybody. Depending upon the private exchange rules, employer will need to decide how much involvement they want in the plan choice. And this gets back to the funding model. Do they want to stay with the traditional style where they're maybe just offering one plan or a couple different plans and the employee chooses and they pay a percentage of the employee, and the dependent premiums basically kind of staying as is, because that might be easy, right, to the employees and to the employer because it's not a lot of change? Or do they want to go to this defined contribution model where they're going to fund a certain amount of dollars, and then it's up to the private exchange in helping support that employee making the correct buying decision. The challenge with the defined contribution method, though, is that when you have employers that have multiple state employees, particularly we're talking large employers right now, that have multiple state employees, the premiums most likely are going to be different, okay, because you're going to age rate inside of that private exchange. Therefore, the employer is going to have challenges or most likely going to have to overspend in their defined contribution to be able to make sure that they stay within the guidelines so that they're not penalized for people going to the exchange and receiving a tax credit. The other thing is, again, the employees want easy. So it's going to be very important for the long life of that employee wanting to buy inside the exchange, the private exchange, and the value or the experience that the employer and the employee receive needs to be easy for everybody, from paying the bills to enrolling to getting information to the support around claims. All of that stuff still needs to be easy, because I think we all agree employees definitely have some challenges with understanding all the components of the benefit. So can it be done better? Is there a better way to do it? Because I think ultimately that's what we're talking about. I think one of the key benefits here is that with the exchanges, and the thing I like about it is that it's an opportunity to start from scratch, to reassess and reevaluate and implement all new ideas for that employer, which in a large group is maybe difficult to communicate. But again, that gets back to what the private exchange is designed to do. Okay, so we're at about 10:27 right now. I'm going to go back through a couple of the questions and try to answer those the best I can here. Let's see. When did the SBC for $500 contributions go into effect? So the SBC piece for the FSA, the HSA, and SBCs in general all last year. It's been in effect for a while now. So based off the renewal, they need to start issuing those. Otherwise, there's tax penalties that could be assessed. Another question came in: do premiums have to be funded by an HRA? No. There's a couple of different options now, and one of the things that we're starting to find, and maybe there'll be new guidance around this, and limiting it just like it was already done now. The premiums today potentially could be funded through a Section 125, not an FSA, not a premium-only plan, but it's called a premium reimbursement plan that could fund these these premiums. Okay, so that is potentially an option there. And being that it's not an HRA, which is what the guidance was specifically about, on January 24th, these might get around some of the rules that exist. Okay. But all it takes is legislative pen to change that. So I imagine once people start figuring that out, there'll be rules around it too. And then another question: what if the employer pays the carrier list bill and have the employee either pay their share with post or pre-tax dollars? Employees can always use post-tax dollars. That's never been the challenge. But then we start losing the benefit altogether of what they're offering. Another question came in: do you anticipate regulations on the group side that may take the HRA funding not workable? Read that one more time. Do you anticipate regulations on the group side that may make the HRA funding not workable for groups as well as individuals? Absolutely. And I think what you're getting there is that the restriction on the plan design. So we have essential benefit rules that are limiting plan options to $2,000 deductibles or less. A lot of insurance commissioners' offices are looking at that as not allowing fully insured plans to be anything above it, like in the state of Oregon and even the state of Washington. So you're basically going to take, where you have average deductibles above $2,000, restrict them down, and then maybe start looking at the option: does the employer think they have enough money to be able to pay for the HRA claims? Ultimately, I think it gets back to why does the employer offer benefits, because that is certainly an important decision they need to make, because eventually, based off the cost versus the benefits, it might exceed it for everything. Is a premium reimbursement arrangement different than an HRA? Potentially. We'd have to define that by the IRS codes that you're talking about, but if you say a premium reimbursement plan, generally those are Section 125 plans and not Section 105 plans, so usually those are different. Okay, I think we've got through most of the questions here. If you have any others that come up, like I mentioned, we're going to send you a copy of these slides and a copy of the recording as well. So I hope everyone has a great day. Hopefully there was some new information here that you're able to use going forward, and hopefully we can find some private exchanges that can create this competitive balance that we're hoping to get. Have a great day.